Okay, hi everyone. Hope you're all doing well and keeping safe. Please bear with me. It's been long. Welcome to the sixth lesson of financial management. That is working capital management. All along, we've been looking at the functions of a financial manager. That is financing decisions, investing decisions, and then today we look at working capital decisions or liquidity decisions. And then in the next lesson, we shall be looking at the liquidity decisions, which involve the distribution of dividends. All these activities involve management or the financial managers trying to minimize the cost of the business so as to maximize the return of the business. So under the financing decisions, we looked at the financial manager's job is to minimize the cost of obtaining finance so as to maximize the profitability of the business. Under the investment decisions, the function of a financial manager is to allocate the finances it has into the most profitable investments so as to maximize also the profit of the company. Today we look at the working capital management, which helps in in which case the management will try as much as possible to minimize the cost of ordering stock and the cost of holding stock among the cost of maintaining other items of working capital, such as debtors and cash, so as to minimize the cost of the business and eventually to maximize the profitability of the business. So today we look at the working capital management. We begin by looking at what working capital is. So what is working capital? So working capital refers to the circulating capital required to meet the day-to-day operations of a business firm. So according to Weston and Brigham, working capital refers to the firm's investment in short-term assets, short-term assets or the current assets. So basically we can say that the working capital refers to a company's current assets. Examples of current assets we have is cash, we have the cash at bank, we have debtors, and we have stock. So working capital management refers to or entails the management of current assets. That is the management of stock or inventory, the management of cash, that is cash at bank and cash in bank, and also management of debtors. So please note that working capital management involves the management of current assets. That is the management of stock, the management of debtors, and the management of cash. So next, look at the concepts of working capital. So here we have the gross working capital and the net working capital. So what is the difference between the two? So the gross working capital refers to the firm's investment in total current assets. Gross working capital simply refers to the management, the current assets of the business. That is the stock, debtors, cash at bank, cash in hand. Can also include the incomes accrued and the expenses, the prepaid expenses paid in advance. So gross working capital refers to the firm's current assets. Whereas net working capital refers to the excess of current assets over current liabilities. So simply you can say that the net working capital is equal to the current assets minus the current liabilities. So from the balance sheet of a business, we can obtain the net working capital by deducting the current liabilities from the current assets. So that is a concept of net working capital. That is the current assets less the current liabilities. The excess of current assets over current liabilities. So it's also the same as here. Number two, that proportion of current assets that is financed by long-term funds. That is, if we exclude the current liabilities from the current assets, that is the current assets minus current liabilities, you get the portion of current assets that is financed by the long-term liabilities. So this number two is the same as the first, number two and number one. So these 2 points, that the net working capital is the excess of current assets over current liabilities, which is the same as that portion of a firm's current assets which is financed by long-term asset liabilities. Sorry, long-term funds, long-term liabilities. Yeah, that is, if we exclude working current liabilities from current assets, we get that portion of current assets that is financed by long-term funds or long-term liabilities. So I hope you get that the concept of working capital, the gross working capital is merely the current assets, whereas the net working capital is that portion of current assets that is financed by long-term liabilities. Or rather, you can say our net working capital is the excess of current assets over current liabilities. So next, we look at sources of working capital. So we are all on the same page as regards the meaning of working capital. So we can all say that working capital is basically the current assets of the business. Yeah, that is a gross working capital, the current assets. Yeah. So what are the sources of working capital? That is the sources of cash, the sources of stock, and the sources of debtors. So the sources of working capital is one, short-term loans. Yeah. We are all in agreement that when a business obtains a short-term loan, that will give the business cash. Yeah. So this short-term loan will be a source of cash to the business. So cash is a part of working capital of the business. So a short-term loan will be a source of cash to the business, and a source of cash will make it easy for the business to obtain stock. Yeah. So the short-term, the cash obtained from short-term loans increases the cash position of the business, and it also has a potential of increasing the stock of the business because the business has that ability to obtain stock with the cash that it has obtained. And then the other source is long-term loans. So just like short-term loans, long-term loans will also avail cash to the business, which will boost the cash position of the business, and at the same time give the business a potential of acquiring more stock, which can also improve the inventory position of the business. And then another source of working capital is trade credit. Yeah. So here, say for instance, the business has suppliers who are willing to supply to it on credit basis. Yeah. So suppliers are willing to supply to it on credit basis. So it becomes easy for this business to obtain stock, even when it doesn't have enough cash. Yeah. Can simply go to the suppliers, obtain stock, and pay later. So it's easy for the business to improve its stock position, to improve its inventory position when it has suppliers who are able to sell to it on credit basis. Yeah. So, and also another source of working capital is say the business can sell a fixed asset. So selling out of fixed assets. So okay, the effect of selling a fixed asset is money coming into the business. So that is an improved cash position. That's an improved cash position. So when you sell a fixed asset, the business will get money. This will increase its cash. So the working capital in regards to cash position of the business will improve. So selling of a fixed asset is also another source of working capital. And then, other than the above sources, firms finance their working capital through paying debt as late as possible. So this will improve the position, will increase the position of debtors of the business. So debtors is also a part of working capital of the business. Yeah. So when we prolong, sorry. Okay, I think I've mixed myself here. So by paying debts as long as possible, it means that our cash position still remains intact. We don't pay. Yeah. When you don't pay, it means our cash position is intact, that our cash position doesn't decrease. Yeah. So when we prolong payment of debt to our creditors, when we prolong the payment of debt to our creditors, we safeguard our cash position, because our cash position doesn't go down in respect to these creditors that we've postponed their payment. So this improves our cash position. it ensures that we retain our cash position as intact. And then number 6, collecting from debtors, from our credit customers as early as possible. Yeah, so we need to push our credit. Number 2 source of working capital is by collecting money from receivables from our credit customers or debtors as early as possible. So this will increase our cash position. Yeah, so we need to push our credit customers to pay as early as possible so as to improve our working capital, to improve our cash position, so that we are also able to acquire more stock for sales. So those are some of the sources of working capital. That is obtaining loans from the bank, both in the short term or long term. We can also obtain working capital by selling a fixed asset that maybe we no longer use. Yeah, we can also obtain working capital by postponing payment to our credit suppliers or our creditors. We can also obtain working capital by collecting from our debtors as early as possible. And we can also obtain working capital by buying buying on credit basis. Yeah, we may not have enough cash in our safe, but we have the possibility of buying on credit basis, which will improve our stock position in the stores. So below there, you see the examples of current assets and current liabilities, which encompass the working capital of the business. We all know what current assets are and their examples. So examples of current assets we have is cash. We have short-term securities. Yeah, that's an investment to the business. Yeah, short-term investments which have a potential of being converted into cash. We have debtors. We have bills receivable. We have stock. We have prepaid expenses. So those are some of the current assets that we have. But the most common ones we have is cash, we have debtors, and we have stock. So cash, you can have cash in bank and cash at hand. And then we have current liabilities. Mostly we have creditors, and we have bank overdrafts, short-term loans, outstanding expenses, and bills payable. Yeah. So the gross working capital encompasses only the current assets. The net working capital encompasses the current assets minus the current liabilities. We proceed. Determinants of working capital. So what factors determine the working capital position of the business? Yeah, they will affect our working capital. So they will affect our level of stock. They'll affect our level of cash. Yeah. So we look at these factors that will affect our working capital positions. So we have 2 factors, that is internal factors. We have the internal factors and the external factors. So we begin with the internal factors. Yeah, so these are the factors internal to the business that will affect the cash position of the business. So first, we have the nature and size of the business. The nature and the size of the business will affect the working capital position of the business. So, for instance, the nature of the business. The nature of the business, for instance, we have a service company, a company that produces service, and we have a company that sells goods. Yeah, say for instance a kinyozi, yeah, or yeah, a kinyozi, or say a massage parlor. This is a business that doesn't rely so much on stock, so you will not expect this business to have a high stock position in its store, because it doesn't rely as much on stock. The same case applies with a service company like a bank. A bank, you know, its a business is to offer loans and the safe custody of money. So this company will not be in need of stock as much as possible, as compared to a retailer like Naivas supermarket or the kiosk that is in your neighborhood. Yeah, the kiosk or the Naivas supermarket will need a lot of stock in its store because of the nature of the business. You have a service company and you have a goods supplying company. The service company may not need a lot of stock in its store, whereas A trading company will need a lot of stock in its store. So the nature of the business will affect the working capital needs of the company. Yeah. So in this case, in regards to stock, for banks, they need a lot of cash with them. Yeah, because their business is to keep safe custody of the customers' funds. So this will improve their cash position, and at the same time, the banks will need to have cash with itself to serve the needs of the customers who want to withdraw their money. So such the bank also needs a lot of money with itself. The banks also supply loans to its customers. So as such, to supply a loan, you need to have money to, to lend. So banks need a lot of cash with them. So as such, the nature of the business will affect the, the working capital needs of the business, and will also affect the working capital position of the business. Still under this point, you have the size of the business. Big organizations will require large levels of working capital as opposed to small organizations. So take for example, that small kiosk in your neighborhood, compare it with the big kiosk like say Naivas supermarket. You can easily see the difference. So Naivas supermarket will have a lot of stock in its store because it's a big organization. Whereas that small kiosk in the neighborhood, you can tell, cannot compare the amount of stock in that small kiosk and what is in Naivas supermarket. So the size of the business will also affect the working capital level of the business. Then number two, internal factor affecting the working capital position of the business is the firm's production cycle or the manufacturing cycle, or simply we can say the period of manufacturing. So I can say that the longer the manufacturing cycle, the higher the working capital needs, and vice versa. That is, the lower the working capital cycle, the lower the working capital needs. So in this case, if it takes longer to produce your end product, it means you will need more stock in your store. Yeah, because in order to be able to satisfy the needs of your customers. Yeah, so that you don't want a situation where the customer comes and always you are telling them that the product is in the manufacturing cycle, so please wait. Yeah, you want a position where the customer comes and you sell to him immediately and you get that money. Yeah, so as such, if the production cycle is long, you need stock in your store, so that even if so that yeah, even if there's something that is being produced, there is something on standby in the store for you to sell if the customer comes. So as opposed to when the production cycle is short, so if it takes a day, for example, to produce a commodity, you may not need as much in the store because it's easier to stock your store, yeah, from the production. Yeah, so the customer can easily wait. Say for example, if it takes a minute to bake a chapati, or to bake that piece of bread, if it takes a minute, it means that the customer can easily wait for that 1 minute. So he comes, orders, and you embark on the production process. Within a minute, you've supplied. But if it takes a day for you to bake that cake, then you can imagine telling the customer to wait for a day for that loaf of bread. So that will affect the manufacturing cycle, will affect the working capital needs. The longer the manufacturing cycle, the higher the working capital needs. And vice versa, the shorter the working capital cycle, the lower the working capital needs of the business. And then the firm's credit policy. So the credit policy of a firm influences the credit policy influences the working capital position of the company. So the credit policy influences the working capital position of the company. So a firm following a liberal credit policy to all customers requires a high working capital. On the other hand, a firm adopting strict credit policy and grants credit facilities to few potential customers will require less amount of working capital. So these are, in my own words, the credit policy of the business will affect the working capital position of the business. Say a strict uh, credit policy. So in this case, with a strict credit policy, the firm doesn't easily extend sell on credit to its customers. So in this case, the sales may not be as high. Yeah, the sales may not be as high because not all customers will be able to buy on cash basis. Most of them will come on credit basis. So if most of the customers are on credit basis and you have a strict credit policy, then you are not able to sell to as many as possible. As such, you do not need a lot in your store to serve these low sales. Yeah, the higher the sales, the higher the working capital requirements. So if you want to sell more, you need to have more in the store. And if you are selling less, you don't need more in the stock. In the store, you need less. Yeah. So if this credit policies are stringent, then the firm doesn't need a lot of working capital because its customers will be few, its sales will be few. As such, the working capital needs of the company will be less, as opposed to when the firm adopts a liberal credit policy, whereby it sells on credit basis, say to everyone. So in this case, there will be an influx of customers. As such, the company will need a lot of working capital. It will need a lot of stock in the store because there's a huge demand for its products. So for it to meet this demand, it needs a lot of stock in its store. At the same time, it needs a lot of cash. Yeah, a lot of cash to buy this stock in order for it to be able to sell to the customers. And then availability of credit to the firm. Yeah, so the higher the availability, this is the fourth factor of affecting the working capital position of the company. So that is the availability of credit to the firm. So the higher the availability of credit, yeah, the higher the working capital position of the business, and vice versa. The lower the availability of credit, the lower the working capital position of the company. Because with the higher the availability of credit, so in terms of cash, if credit is easily available, the business will easily be able to obtain cash. Yeah, so that improves the working capital in reference to cash. So the cash will be high in the business. At the same time, the business will be able to obtain stock. Yeah, so credit availability of credit may also refer to credit from suppliers. Yeah, so if there is availability of credit supplies, then it means that the business is able to obtain stock. Yeah, as such, the stock position will be higher. Whereas when the availability of credit is low, the business may not be able to have as much working capital as it needs because it may not be able to easily get cash. As such, the cash position will be low, and the stock will also be low because the business will not be able to uh, may not be able in a position to obtain credit supplies from its suppliers. So availability of credit will therefore affect the working capital position of the business. And then the growth and expansion of the business is a fifth factor of working capital position. So working capital requirements of a business tend to increase in correspondence with growth in sales and fixed assets. So if a business is growing, it needs more working capital. Yeah. So remember, in the our first factor was the size of the business as a factor of working capital position. So the same case with expansion. As a business expands, it requires more working capital. Yeah, to serve this growth in sales, to serve the growth in demands. So as such, the business will need more working capital. And then another factor is profit margin. So the higher the profit of the business, the higher the cash. Yeah. So mostly in most cases the profit will be in the form of cash. Yeah. So you make more profit. This will be a source of finance to the business, source of more capital to the business. You remember the concept, the second topic, the sources of finance. We had one of them, retained earnings. Yeah. So when the retained earnings are high, it means that the business has more cash. So that will have a positive effect on the cash position. And it's also likely to have a very huge positive effect on the stock position of the business. Yeah. So the higher the profitability will lead to a higher cash position and a higher stock position. So the profit margin will increase the stock position and the cash position of the business. So therefore, we can easily say that a higher net profit contributes to the working capital pool of the business. And then the number 7, the operating efficiency of the firm. So this is the same as goes hand in hand with the profit margin. So the more efficient the business is, means the more profitable the business is, and as such, the higher the ability of the business uh, to obtain cash. Yeah, because the profit is high as a result of high efficiency. When the profit is high, it means that our cash position will be high, our cash position will increase if we retain these profits. And this also has the potential of the business improving its stock position because it has enough cash to buy stock. So operating efficiency by reducing the cost of operation will increase the profitability of the business, which will in turn increase the cash position of the business. I hope you are all together there. So those are the internal factors affecting the cash position, the working capital position of the business. Next, we have the internal factors affecting the working capital position and the needs of a business. So among the external factors we have is business fluctuations. Yeah. So these fluctuations comes from the general economic trends. We have periods of boom, we have periods of recession. So currently with the COVID-19 coronavirus, the economy is under recession. So this recession and boom in the economy will affect the working capital position of a business. So under the periods of boom, when the business is high, the demand of the business's products is high. In such a situation, you'll find that the working capital position of the business will also be very high, because one, if the business operations are high because of a boom in the economy, you find that the business is making more sales. Yeah, the higher the sales, will mean the higher the profitability because of the increase in sales revenue. So the higher the sales revenue, the higher the profitability. You also expect that the cash position of the business will be high. Yeah. So the working capital in regards to cash will be high because of a boom. Yeah. Another instance of a boom position is when, because of high sales, high demand, the business will need to stock itself highly to meet this high demand. So therefore, the stock position of the business will be quite high, yeah, because of the increase in demand. So therefore, you find that under boom, the businesses will have a lot of stock, a lot of cash with itself. Yeah, because with the increased sales, there will be an improvement in profitability, and the profitability will improve the cash position of the business. Yeah, and at the same boom situation, you find that the demand of the business products will be high. As such, the business will need to stock itself well so as to meet the demands of the customers. So, and vice versa applies to a recession. During periods of recession, you'll find that the working capital position will be quite low because of reasons I have explained. And then number 2, the changes in technology. So in this case, technology, we're talking of production technology. Yeah. So when the changes in technology will affect the working capital position of the business. So say for example, the manufacturing technology keeps improving over time. So if it keeps improving over time, you expect that the production cycle will shorten. The production time will shorten, yeah, with improving technology. So you find that with an improving technology, it takes a shorter period of time to bake that bread, yeah. So if it takes a shorter period of time to bake that bread, you don't need a lot of bread in the store because the customers can easily wait for you to produce for them. So therefore, the improvement in technology will lower the working capital needs of the business, and vice versa. If the technology is bad, then you need a lot of stock in the store because the technology process may fail you, and as such, you may not be able to serve your customers. So for you to be able to serve your customers well with a bad technology, you need to have a lot of stock in the store. Yeah. So the inventory, so we can say that if a farm wishes to install a new machine in the place of an old system, the new system can utilize less expensive raw materials and inventory needs may be reduced. Thereby, the working capital needs of the business will also be less if we improve our technology. And take the simple example of that loaf of bread. Yeah, a better technology will produce that loaf of bread within a very short period of time. So as such, you may not even need something in the store, as opposed to a weaker technology, And then number two, import policy, the third external factor affecting the working capital needs and position of the business. So for instance, the import policy of the government may also affect the levels of working capital of a farm, since they have to arrange funds for importing goods at specified times. So for instance, the government imposes high tariffs on imports. Yeah. So the government imposes high tariffs on imports. So it becomes expensive for businesses within the country to import because of the high tariffs. So this will affect the working capital position. One, it will be hard for businesses to stock their stores because it becomes quite expensive. Yeah. So the higher the price, the less the higher the price, it means that the business will not be able to purchase as much as when the prices are low. Yeah. So when the government imposes high tariffs, you find that the working capital position of the business will go down. Yeah. The working capital position of the business may go down with increase in tariffs in regards to imports. Another factor is taxation policy. Taxation policy by the government will also affect the working capital position of the business. One thing with tax is that it makes items to be quite expensive. So if the government imposes tax on a commodity, you expect that the price of that commodity will go up. So this will be quite expensive for the company to acquire this commodity. So this will lower the working capital position of the business. Another thing with tax policy is that since it makes commodities to be quite expensive, is that the tax policy will lower the profit of the business. So the higher the taxes imposed on commodities, the lower the profit the business will earn. Because one, it will sell less. Two, it will acquire these commodities at a higher price. So the cost of production will be high. So this will lower the profitability of the business, and the lower the profitability will mean the lower the cash position of the business, which will also likely lower the stock position of the business. So those are some of the factors affecting the working capital position of a business. So next we look at the importance and the advantages of working capital, of having an adequate working capital. So working capital could be quite beneficial to the business, that is having cash in the safe and stock in the store could be quite beneficial, and on the other hand could be a burden to the business. Yeah. For instance, with stock, yeah, with stock, you need stock in your store for you to be able to operate smoothly and supply to your customer, isn't it? You need to have your stock. If you don't have stock in the store, then you may run out of business because you may not sell anything. So and the business may not operate well. So you may end up losing your customers, and in the end, the business may shut down because of constant losses. At the same time, we may have perishable stock. Yeah, perishable stock like food commodities. Yeah, they may not last for long before they spoil. So you may have too much food items in your store, and then you're not able to sell as much, and then they get spoiled in the store. It will be a loss to the business. So stock could be of benefit to the business. At the same time, it could be a burden to the business. So we look at the advantages and the disadvantages of working capital, of having adequate capital. So begin with the advantages of adequate capital. One is that the liquidity of the business will be high if the business has sufficient working capital. So it's able to convert its assets into cash. Yeah, it's able to pay its current liabilities if it has enough current assets in its with itself. So if it has enough cash, it can easily pay its current assets. It can easily buy stock. It can easily sell. So the business will be healthy. Yeah, the business will be healthy because of having adequate stock in its store, and also because of having enough cash in its safe and also in the bank. Yeah, so that way the business will be healthy. So they say that the working capital of a business is the lifeblood of the business. Yeah, and the nerve center of the business. So just as circulation of blood is essential in the human body, working capital is essential in the business. Yeah, so the working capital is the blood of the business. So the business needs to have enough blood, yeah, to maintain its liquidity, to maintain a smooth operation. Another advantage of working capital is goodwill. Yeah, you get a lot of goodwill from your customers because they come and get good commodities. Yeah, because the flow of goods is smooth. Yeah, is effortless. You find that the customers keep coming back because of that goodwill. You can compare yourself with good stock with someone who doesn't have enough stock. Yeah, so you are, as a customer, you move into a shop and it has nothing to sell to you. You are not likely to go back to that shop again because of the dissatisfaction you received in the first instance when you went there and you are not able to buy anything because they did not have anything to sell. So you lost the goodwill in that company. So with an adequate level of working capital, you'll find that the businesses will be able to maintain and improve their goodwill. Yeah, so sufficient capital, working capital enables a business concern to make prompt payments and hence helps in creating and maintaining goodwill. Yeah, so goodwill also with the creditors, because with your good cash position, you're able to pay your creditors in time. As such, your goodwill with the creditors will be high. The creditors will be willing to sell to you on credit basis because they know that you're able to sell to pay them as and when the payments fall due. And then adequate working capital also has the advantage of easy loans. So a business having adequate working capital will have high solvency or high liquidity, and will have a good credit standing, and as such can arrange loans from banks on favorable terms. And then number 4 is cash discounts. So with cash discounts, a business that is able to buy in large quantities, yeah, can be granted cash discounts. Yeah, the cash discounts. Say at the cash discounts usually arises at the time of paying for a um, credit purchase. So if the business is in a strong cash position to be able to pay for credit purchases in good time, it may be given cash discount by the suppliers. Yeah, so therefore a strong cash position will benefit the business in the form of being able to be given cash discounts. Yeah, being able to be given cash discounts by the suppliers because the business is being able to pay in good time, which will be impressive to the creditors who can at the same time therefore grant cash discount to the business. And the cash discount will be beneficial to the business because the business will pay less. As such, the cost of the business will be lower, which will improve profitability of the business. So another advantage of a good working capital position is regular payment of salaries and wages and other expenses, because the business has enough cash in its safe and in the bank. So the business is therefore able to pay its salaries in good time. It's also able to pay its other expenses in good time. And then exploitation of favorable market conditions. So if the business has enough cash in its store, it's easy for it to exploit market opportunities as they arise, as opposed to when the business doesn't have cash. So if you have cash, an opportunity arises, you easily take advantage because you can easily buy you invest in that or in that opportunity. You can, for example, if say for example, you find a motor vehicle being sold at a very cheap price, yeah, that's an opportunity. If you have that money with you, you take advantage of it. But take an example of when you don't have that money, that opportunity will come and go. You're not able to exploit that opportunity because you don't have enough cash in the store. And then with a good working capital position, so the business has enough cash, it's able to make to earn quick and regular returns on investment. Yeah, because of the profitability. We've seen that with a good cash position, with a good stock position, the profitability goes hand in hand with working capital. Yeah, the higher the profitability, the higher the working capital. At the same time, the higher the working capital, the higher the profitability. Because of the smooth operations, you're able to sell easily. The operations will be smooth. You will have enough cash in your stuff, in the safe. The business will be able to take advantage of opportunities. The business will be able to take advantage of cash discounts from creditors. As such, the profits will be high. Yeah, so there's that good positive relationship between working capital and profitability. So uh, this will in the end improve the profitability of the business. So you find that the business will be earning high returns on profits, on investments, yeah, because of the goodwill with the customers and the goodwill with the suppliers, yeah. The sales will be high and as such. So yeah, a good working capital will improve the profitability, which will improve the return on investment of the business. And number 8, an advantage of adequate working capital is high morale for the employees who are paid in good time. Yeah, they'll be motivated to work better, which will minimize the cost of the business, which will maximize the profitability to the business, which will in turn maximize the profit of the business. And the good cycle will continue with the high morale. So the high morale will also come from the creditors of the business, who will easily sell to the business on credit basis, because this is a business that is buying and paying in good time. Yeah, so the business obtain can obtain stock on credit basis and improve its sales and maintain a smooth operation. Yeah, so from the high morale of both the creditors and the customers of the business, and also the high morale of the employees. Disadvantages of redundant or excessive working capital. So working capital could be of benefit to the business, but at the same time, working capital could be a burden to the business. And I give a good example of perishable goods. Yeah, you have excess of them in the store, they all spoil, you go at a loss. So redundant cap or excessive working capital could come as a burden to the business. Yeah, it could yield a loss to the business instead of a profit. So excessive capital, working capital, means idle funds. This should be idle, not ideal. Yeah, idle funds. Yeah, so funds that are just there that are not being utilized. Yeah, and idle stock. So excessive working capital means idle funds which earn no profits for the business, and hence the business cannot earn a proper rate of return. Yeah. So and then number 2, when there is redundant or excessive working capital, it may lead to unnecessary purchasing and accumulation of inventories, leading to chances of theft. It's even theft as a reason, because you have too much stock in the store, it becomes tempting to theft. Yeah, wastage of perishable goods, and this will lead to losses. So the business needs to only have an adequate level of inventory, of cash needs, the business needs to have an adequate level of cash. The business needs to have an adequate level of stock to minimize losses to perishability, losses to wastage, losses to theft. Excessive working capital, number 3, implies excessive debtors, and a defective credit policy may lead to higher incidences of bad debts. So debtors are current assets, which is a component of working capital. So the higher the debtors level, the higher the probability of bad debts. And a bad debt is a loss to the business. Yeah. So the business will lose its money, the result of bad debts, debtors who are not willing to pay their debts. So the business needs to keep an optimum level of debtors so as to minimize the chances of bad debts. And then uh, excessive working capital may lead to overall efficiency because the business may incur a lot to to pay for this stock in the store. Say, for instance, to minimize the event the cost of theft, of thieves, of stealing. You need to employ a good sales company, security company. Yeah, so security costs will go up to safeguard the stock. So the store, the high levels of stock will need high levels of security. Security will come at a cost. So this will be inefficient to the business. This will be expensive to the business. And then redundant working capital will lead to speculative transactions. Speculation comes with risks. Yeah, the higher the risk, the lower the profitability may be affected. You know, the risk goes you may with risk we have the fluctuations in returns. We have the good times and the bad times. So with the bad times, with risk, you lose. Yeah. So a redundant working capital gives rise to speculative transactions, which are risky, which may yield bad times to the business. So next, we look at the management of the various items in the working capital. So working capital, in this case, we look at the current assets. So examples of current assets. Okay, I had skipped an item, the disadvantages of or dangers of having inadequate working capital. Yeah, so let us first look at the disadvantages or dangers of holding inadequate working capital. One is that with inadequate working capital, the business may not be able to pay its short-term liabilities in time, may not be able to pay its short-term creditors as and when they fall due. So as such, it will lose its good reputation, and in future it may not be able to obtain credit from its suppliers. So it may lose its reputation, it may lose its goodwill with the suppliers, which may